Morning and welcome everyone. One moment while I grab my guest up on stage. If you're in the audience, feel free to let us know who you are and introduce yourself. Cool, Richard will be coming up in a second. Perfect. Cool. Hi Richard, welcome. Thank you for joining us today. Oh, can you hear me now?
No.
Let me see. Can the audience hear? Okay, the audience can hear. Might be a sound issue on your end.
Might be in silence.
Everyone can hear both of us. Yeah,
I might go out and come back in again.
We'll see if that works. Might not help if Richard can't hear me. Hi, Anne. Okay, everyone can hear. I'll just need to get Richard back up on the stage. Sorry, guys. Okay. Cool. Can you hear me now?
No. No. I can hear you. I can hear you when I go
how
out.
Strange.
And
There's a little settings button in the top right corner. Oh,
up the top.
yeah. Is not connecting. Sorry.
Okay, now.
Okay, can you hear me now?
Okay,
cool.
Yeah.
Sorry for the little technical
difficulty.
Cool, it's working now, so it's all good. Cool, my name's Stacey and I'm the Content and Social Media Manager here at Relab. And joining me on today's webinar is Richard Ashby, partner at Gilligan Shepherd. If anyone's taken a look through our website, you'll see we've done a bit of work with Gilligan Shepherd before, so it's really nice to have Richard on today. So this morning we're talking about land and the bright line test. Knight, our CEO, actually came across one of Richard's really good blog posts where he was talking about the topic, and we thought it would be really worthwhile getting Richard on the webinar to talk about it, because there's some really great takeaways for the audience. You can take away Richard's 8 lessons that he's put together and hopefully be more confident in understanding the bright line test, as there are a few changes happening and it can get a little bit complicated there. And it's also a really good opportunity to ask some questions to an expert in his field. With that being said, Richard is pro at this, but please don't take anything discussed here as financial advice, and make sure you consult a professional you trust before making any decisions. Just got to note that there. And just a few notes before we start. Now, please do put your questions in the chat as we go along, and we'll get to answering those at the end. However, please do try to stay away from asking like personal tax or property situations, as we can't answer those ones for obvious reasons. We also have Louise from the Relab team monitoring the chat, so if there's any general webinar questions or tech issues, she can help out. And lastly, you will receive a recording of the webinar sent straight to your inbox later today as well. It will also be available on our YouTube and socials. Cool. I see a question there saying can't hear. Can everyone hear fine? I think it might just be one person. Cool. So we'll get on to the actual topic for today. To start us off, Richard, can you please give us a bit of insight into your background and what you do? As I understand you've had 30 years of experience in New Zealand taxation, so you must have done quite a bit there.
Yeah, I left school at the ripe old age of 16 and went straight to the IRD as a young cadet, and I spent about 8 years there. The last 4 of those I was in investigations, and then I decided to change sides. So I worked for a small CA firm for about 18 months, and then I went through the doors of Gilligan Shepherd, and that was nearly 26 years ago now.
Wow.
So it's been half my lifetime that I've been at Gilligan Shepherd, and I'm the tax partner there. So I've got a small tax team. We spend our days providing an advisory service to other chartered accountants, accounting firms who might not have their own internal tax resource or just want a second opinion. We obviously advise our own clients. I do quite a bit of cross-border work, non-residents looking to come to New Zealand, either themselves or their businesses. And as Knight picked up on, I write a few articles on various topics that I think might be interesting for the general public. And I get quite a few cold calls off those articles just asking for advice or opinions.
So I will, I've got the lessons that you've outlined in the blog article in its slides, so I'll bring that up on the screen. Cool. So and yes, as we go through them, Richard can talk to them in a bit more detail. And yeah, as we go along, we'll see what questions pop up as well. So lesson 1, are you actually dealing with residential land as defined?
Yeah, I think I made this point because from some inquiries I've had, sometimes people think that the Bright Line rules apply to all types of land, so even commercial land. But even when it's residential land, it's really only if it's got either bare land that can have a dwelling erected on it, or it already has a dwelling erected on it. And I had a recent case where it was residential land by definition in terms of the council zoning, but it actually had a commercial structure on top of it. And the client was concerned because they were selling it within the Bright Line period. So it was really just to point out, just the first thing you need to do is actually look at the land that you're disposing of, and does it come within the residential land definition? And there are a couple of carve-outs for farmland. Obviously, it needs to be of an economic size for a farm, and also business premises. And another, I guess, curly issue I find here is people quite often think they are, and they could be indeed in the business of renting residential properties, and so they think they can claim the business premises exemption, but that's not, you're not actually operating a business from the land. You are leasing the land to someone else who's operating their business from it, so it can still, that's living on it, so it can still be deemed to be residential land. And finally, just to make sure that you understand that the Bright Line rules apply for a New Zealand tax resident, land owned anywhere in the world. So it's not just land owned in New Zealand. If you own residential land in Australia, for example, and you sell within the Bright Line period, then you've got a Bright Line tax issue.
Cool. And lesson 2, appreciate the other land tax provisions which may apply before the Bright Line rules.
Yes, I raise this because a lot of people just jump straight to Bright Line, and in most cases that will be the ultimate outcome. But there's actually a number of taxing provisions that apply to land. There's sort of a pecking order. So Bright Line sort of comes about 8th in the list. And we had a case where a client, for one reason or another, had actually sold their residential land for a loss. Now, if they were taxed under Bright Line rules do not allow for a loss. You can't claim it against other income sources. What you can do is carry the loss forward and then offset it against future land sales income, which you may or may not have any of. But if you, for example, were taxed under, say, the intention of resale test instead, so in other words, you bought the land with the intention of resale, then that has no loss limitation. So in that case, the client basically argued that they sold it within 2 years, they bought the land with intention of resale, and therefore the loss was deductible against their other income. So just appreciating the order in terms of the land tax rules.
And lesson number 3, is it the acquisition date? Is the acquisition date, not the disposal date, which dictates the bright line period applies to the land?
Yeah, and I think this is quite critical, and I've certainly had examples where it's been very will come out in favour of the client. A lot of people, when they go to dispose of the land, they just think it's the bright line period that's in play at the date they dispose of the land that applies. But to actually establish which bright line period applies to you, you first need to look at what date did you actually acquire the land. And often for date of acquisition purposes, that'll be the date that you entered into a binding agreement to buy the land. Now, if on that date you entered into that agreement, it was a 2-year bright line period, then even if you sold the land when there's a 5-year bright line period in place, it's a 2-year period that applies. So I had a very happy client, for example, that he had title issued to him in August 2018. Now, usually for the bright line period, the commencement date is the date of transfer of title. So he just thought, I've got a 5-year bright line period. I'm selling within 5 years, so I've got to pay some bright line tax. But he'd actually entered into the agreement to acquire the land in December 2017, when there was a 2-year period in place. So because he was selling in 2021, he was quite happy when I told him that only a 2-year period applied and he had no bright line tax to pay. So just be aware of your date of acquisition of land for determining which bright line period actually applies to you.
Cool. And this is probably a good point to mention. Recently, there was added the 10-year bright line period. Can you talk us through what happened there a bit with the additional bright line period added?
Yeah, unfortunately, the government, or they should keep this non-political, of course, seems to be, suggesting that particularly the Auckland housing market is overheated due to a whole lot of speculators we have in the market, and potentially that's why bright line rules were first introduced. The Revenue's always had an intention of sale rule that they can rely on. But in some ways, I suspect they found that too hard to implement, even though the onus is on the taxpayer to basically dispute any sort of assertion made by the Revenue. So the government brought in a 2-year rule. Obviously, it had no effect on the housing market, as we've all seen. They then increased it to 5 years in 2018. Still no impact on the housing market. So now I guess they believe that a 10-year rule is more appropriate. Some would argue it's a quasi-capital gains tax being brought in by stealth. But I think it is really just about that. They want to try and do something with the Auckland housing market, and this is a tool they believe can achieve that.
Perfect. Okay, moving on to lesson number 4. If land acquired post 27th of March 2021 contains a new build, when disposed of, a 5-year bright line period applies.
Yeah, so as part of the increase in the bright line period to 10 years, the government obviously also didn't want to put a dampener on encouraging new housing supply, because of course that to me is a real problem, and particularly the likes of Auckland. It's a supply and demand issue that's pushing up price, not because we have a whole lot of speculators. So to encourage new home builds, they introduced or essentially retained a 5-year bright line period where you have what they call new build land. So either you have yourself acquired land that has a new build on it. So basically you've acquired the land within 12 months of the issue of the CCC for the new build, or you have bought land or have existing land and you have erected a new build on that land, and provided that new build is still on the land when you go to sell it, you are subject to a 5-year bright line period as opposed to a 10-year bright line period.
And I was listening to another discussion around this, and they were saying that the definition for new build was still to be properly established. Is in your opinion, is that a bit of a question in the air at the moment?
No, it's basically a new build as I believe is defined, particularly if you look at the interest limitation deduction rules, as one that has had its CCC issued post 27th of March 2020. I think the confusion was around when they first promoted or brought out the pending legislation. They suggested it'd be one where a new build had been added to the land and issued at CCC after 27th of March 2021. So they actually took it back 12 months. So, but for the bright line test purposes, in order to get the 5-year concession, you must have acquired if you are acquiring land with an existing new build on it, it must be within 12 months of the issue of the CCC. So if it's outside of, if you buy a new build, but the CCC is more than 12 months old, then you're into the 10-year period.
Cool. And lesson number 5, once Brightline has application, there are very few exclusions.
Yeah, certainly it's what I call very draconian legislation, because once you're caught, it's not like some of the other rules, particularly the intention of resale, what I call the old rule, where you had a client got into a matrimonial situation, which is relatively common these days, unfortunately. And as a result of that, financial pressures, they had to sell the property. At least you could show sufficient evidence that that was the reason they were selling. It was not because of sort of any original intention to sell, which would have tainted them. Bright line's just pretty much black and white. If you sell within the bright line period and it's not your main home, then you're caught. You've got to pay the bright line tax.
Cool. I might ask one of Nathan's questions here. What if you added a bedroom and bathroom to an existing dwelling and subsequently received CCC? Can you claim interest deduction?
Okay, that's a little bit off topic, because that talks more about the interest deduction rules. Then there are some rules, I believe, some modifications to the interest deduction limitation rules where it applies to some alterations made, but normally it talks about a self-contained unit. So whether you would be able to argue that addition of a bedroom and a bathroom to an existing dwelling now makes it a new build, I'm not sure. I think you might be on a bit of icy ground.
Cool. I'll come back to Nathan's other questions later on.
But certainly for bright line purposes, it's got to be basically a new self-contained dwelling to constitute a new build. So in that case, it wouldn't qualify.
And lesson number 6, the main home exclusion has recently changed.
Yeah, so this is where it starts getting pretty complicated. So if you didn't think it was complicated already, so I'll try and keep it just a real high level. So under the old rules, so if you purchased residential land pre 27th of March 2021, basically it was an all or nothing rule. So you had to show that for more than 50% of the time you own the land, it was used for your main home, and that more than 50% of the land itself was used for main home purposes. So once you're over both those 50% thresholds, you've qualified as a main home exclusion. If you're under either of those 50% thresholds, then you lost completely. You had bright line tax payable. Now, obviously, with the bright line period moving to 10 years, the government thought that wasn't fair. And so they needed to make the main home exclusion rule fit for purpose. So essentially they have what's what's called a time period analysis. So essentially, if the main home now, if you still use more than 50% of the land for main home purposes, then as long as it's used for a main home all the time, there is a carve out that allows for periods of non-main home use up to 365 days. But as long as the land is used more than 50% as your main home, then you'll still be entitled to claim that main home exclusion. If the land is used less than 50% for your main home, then you've got potential apportionment issues. And the basic effect of the calculation is that you should only pay brightline tax on the non-main home portion of the land, or the main home portion of the land that's not used as a main home for periods more than 365 days. So it's just a bit more of a complicated calculation, and there's now apportionment involved. But I do think it's a much fairer calculation than what we had before.
And lesson number 7, new rollover rules have been introduced applying to transfers of land occurring post 1st of April 2022.
Yeah, so this is where, out of all the proposed policy changes, I had a bit of a smile on my face, because I've sort of been wanting this to come in for quite some time. And the whole rationale behind these changes is basically where there's been no economic change of ownership, then brightline shouldn't apply. So classic scenario was a person who wished to transfer the residential land from themselves to their trust. For those that were unfortunate, they didn't get in touch with us first and ask for some advice. They just thought because they were just transferring land from themselves to the family trust, they were associated, and therefore, brightline wouldn't apply. Under the old rules, of course, the transfer from basically anyone to anyone else, unless it was a relationship property or upon death, restarted the brightline clock. So now the government's recognised that if there's no economic change of ownership, so settler to family trust, as long as the settler is one of the beneficiaries of the family trust, look-through companies or partnerships to either partners or look-through company shareholders, or vice versa, and also from, say, a joint tenant scenario to a tenants in common scenario, or vice versa. And the main thing to remember, other than the family trust one, is that the ownership proportion is the same post-transfer as it was pre-transfer. So if you're changing your title from joint tenants to tenants in common, then basically, there's a deemed, depending on how many joint tenants there are, you've got to make sure that tenants in common are in the same proportions, and vice versa. Now, probably one to watch out for is there is also rollover relief allowed when a family trust transfers the land back to settlers, but you just be careful, because you have to make sure that when the residential land goes back to the settlers, it's back to the same settlers who transferred the land originally into the trust, and in the same proportion. I think people got a bit confused about it. It's a bit wider than that, but it's quite a narrow concession.
And the last lesson, subdividing the land does not restart the brightline date when the new titles for the land are issued.
Yeah, this is quite a common inquiry where somebody's done a minor subdivision. So they may not have triggered what we call the minor subdivision rule, but they're concerned that they've restarted the brightline clock. The rule is quite clear that when you've undertaken a subdivision yourself, for brightline purposes, it's the original date of acquisition of the land that determines your brightline period, not the issue of new titles for each of the new lots.
Cool. I think that should answer your first question, Nathan. Cool. So we've got through those lessons. I have an extra question. What are the most common situations that you see where people misunderstand or might slip up on when it comes to brightline?
Yeah, I think that and it's not necessarily during the sale period, it's more, I think, around when they do transfers of land without getting proper advice up front. We had a client a couple of years back who brother and sister owned a piece of land jointly. Brother decided to go off and transfer his share in the land to the family trust, probably for asset protection reasons or some other basis. At the time, that made quite common sense. But then they decided to sell it. Now, sister had owned it for longer than the requisite bright line period at the time, so she had no bright line tax to pay. But unfortunately, the brother, because he transferred to his family trust, restarted the bright line clock. Trust then had a bright line issue because it had sold within the period.
Cool. And another question from Nathan on the opposite end. I think this was talking about when we were talking about acquisition. On the opposite end, does bright line period end when S&P is signed or on settlement?
Now, it's the date you enter into the agreement to sell. So basically, when you sign if you have a binding contract to sell, that's the date that you take as the end of your bright line period.
Cool. Cool. So if there's a call for last questions, Nathan's on a roll with a question. Main home exclusion question. If you bought a section and then built your new owner-occupied over 12 months and then moved into the new house and sold 8 months later, would you be caught by partial bright line?
If you bought a section and then built your new owner-occupied over 12 months and then moved into the new house, so presumably it is bare land when he's bought it, and then if you've so in that case it was bare land when you bought it, and then you constructed your new home. Basically, there's a concession now, which is a 365-day concession, although that has been extended for somebody who is constructing, say, a family home, to allow for a period of greater than 365 days, as long as the period is reasonable. Now, what's the definition of reasonable? It's going to be based on the circumstances at the time. But certainly, if you have bought a piece of your land and you are constructing your new family home, and it takes more than 12 months for that home to be constructed for whatever reason, then you will still qualify for the main home exclusion. And then it comes down to your whole, do you then use it as your main home for all the time, or for periods that there is non-main home use, that period doesn't exceed 365 days, or do you put another structure on the land that's not your main home, that takes up more than 50% of the land, then you might have a apportionment issue.
Cool. Well, if there's no more questions.
And I just should make another point, because that actually comes up, that people get caught out on, is its actual use of the land. Quite often I've received a question and somebody said to me, look, I bought a piece of land down in Queenstown, for example. My intention was to use that land as my main home. For whatever reason, that hasn't eventuated. I now want to sell the land. Can I claim the main home exclusion? No, you can't. It's not based on intention, it's based on actual use. So that's quite often where people...
Right, so you actually have to do something before selling.
Yeah, you got to show like a positive. So you have, maybe if your new home was being constructed, but you've got to use the property as your main home before you can claim the main home exclusion. A lot of the other tests are based on intention. Cool. Intention doesn't apply.
A question from Anne: if you bought land and then decided not to go ahead with the new building, I think that's just what we covered. What costs can you take into account under the bright line? For example, building plans, lawyers, geotech, etc.
Yeah, normally what I do is go through it case by case and look at the analysis of costs incurred. But usually, if you have incurred what we'd, I guess, call a capital cost in respect of building that structure, then that should be deductible along with the cost of the land itself in determining what your bright line profit is. And certainly things like resource consents is
Cool.
definitely included.
And from Bruce, sorry, if you buy land under the 5-year rule and build 2 units, when do the units qualify under Brightline?
So if you buy land under the 5-year rule and build 2 units, okay. So if you're talking about the period of the bright line, the bright line period doesn't doesn't change from the date the new build is constructed on the land. In other words, if you buy a piece of land or you already own a piece of land and you construct new builds on that land, when the CCC is issued for those new builds, that doesn't restart your bright line clock. You're still within the same bright line period. All you have to do is construct a new build on your land within the relevant bright line period you're looking at, and then those new builds must still be on the land at the date of settlement, unless they've been destroyed by an earthquake or fire. Then there's an exemption.
Cool. And from Mike, apologies if this has already been asked. I just joined. I bought a place off the plan. Intention was for it to be a family home. If I sell before the completion, does it come under the Brightline test, or do I actually have to live in it? If so, for how long?
Well, if that's what we just talked about just recently, but it is a case of you actually need to use the dwelling as your main home in order to be able to qualify for the main home exclusion. Now, we have this sort of a 365-day concession. So if you build your home, so you continue with the build, and then you lived in the property the whole time as your main home, and then you sold it, then arguably you can qualify for the main home exclusion. What I'd caution you with there though is that don't forget these other land taxing tests or provisions, because you still have the intention of resale test, which is it's the old test, it's been around for a very long time. So the problem is if you buy and sell like this and it's in quite a short period of time, even though Brightline might not apply, the revenue could still try and assert that you acquired this property with an intention of resale.
Cool. And with applying for a main home concession, is there a process that people have to go through to make sure that's watertight?
No, I mean, other than, if you're a bit unsure, then of course get appropriate advice. But it's not like the main thing we know now, and more so in recent years, is the revenue now has a huge property compliance team. The government each year, throws lots of money at the IRD and expects a good return for it, particularly from its property compliance team. Everything in terms of the Land Transfer Act, Land Transfer Register is now online. So it's very simple, particularly with the Revenue's new computer system, which is very smart, to basically just hook into the land transfer system, identify any disposals that have occurred within a Brightline period, and as soon as that taxpayer files their tax return, they'll obviously look for any Brightline income. If you haven't returned Brightline income, they're going to send you a letter and say, we note you sold this property within the Brightline period, please explain. Now that's okay, because it may all be explainable, but that's the time when you go back to them and say, yeah, I didn't need to pay Brightline tax because the main home exclusion applied. That may be enough, or they may ask you for further evidence
Yeah.
of that.
Cool. I think we'll wrap it up there. If there's no more questions, huge thank you for coming on. Oh, there's an off-topic question by Nick. We'll answer one question if you can. How long do you need to hold a new build rental that has been built on subdivided land from owner-occupied property? 10 years, considering the intention was to keep forever.
Yeah, well, if it's residential land, I mean, there's a whole lot of assumptions to make here, I guess. And if you are not within the bright line period, then the bright line doesn't apply. You know, there is a minor subdivision rule. So basically, anybody that sort of subdivides land and adds a new dwelling on, and does that within 10 years, commences that scheme within 10 years of buying the land, potentially triggers the minor subdivision rule. One of the exclusions on that is what we call the investment income exclusion. So if they can show that the purpose of doing that subdivision was to derive investment income from the land, then when they dispose of the land, it may not be taxable. I always get asked, how long do we have to keep the residential property for? I mean, how long is a piece of string? You know, the longer you can keep it for, the better, of course, because the revenue's always got the benefit of hindsight. So they can look at other transactions you've entered into, and all they have to do is make an assertion that they don't think you're entitled to claim the exclusion, and the onus is on you to prove otherwise. So the longer the better is the answer. I mean, certainly if there was a piece of land that was subject to the bright line rules, then obviously if you are converting a piece of the land into non-main home use, then you may have apportionment issues on any exclusion you try and claim.
Okay, cool. Awesome. We will wrap up there. Thank you so much for coming on today. I hope the audience learnt a thing or two. There will be a recording sent to your inbox, and it will be on our socials as well, just for anyone that missed that note there. Cool. Thank you, everyone. Enjoy the rest of your day. Thank you.
Cool. Thanks, Stacey.